Fear has returned to the crypto market. Not the kind that sparks panic selling, but the quiet, exhausted kind that settles in after months of uncertainty. As of early 2025, sentiment on Twitter is overwhelmingly bearish. The Fear and Greed Index has hovered between 23 and 42 for weeks, sitting firmly in the fear to extreme fear range. That's the lowest sustained reading since April of this year. Bitcoin briefly dipped below $100,000 for the first time since May, dragging total market cap down more than 3%. The mood across crypto circles feels heavy, traders talking about capitulation, influencers going silent, and retail investors quietly moving their money into equities. But if history is any guide, fear at these levels has often been the market's most reliable buy signal. According to CoinGlass, data readings below 40 have predicted local bottoms within 2 to 4 weeks with roughly 90% accuracy over the last 5 years. Every major correction since 2020 has started with panic and ended with a rebound once sentiment hit these same levels. The divide between retail exhaustion and institutional accumulation is widening again. On-chain data shows ETFs and long-term holders quietly adding to their positions, while smaller traders reduce exposure. It's a pattern seen before. In 2019, in 2020, and again in mid-2023, each time setting the stage for a sharp reversal once the market ran out of sellers. So the question now isn't whether fear exists, it's whether this cycle's fear still carries the same predictive power, or whether the structure of the market has changed enough to make this time different. Whenever markets turn fearful, the same question comes up. Is this the beginning of a bear market, or just another deep correction in an ongoing bull run? Historically, Bitcoin's 4-year halving cycle has been the most reliable framework for answering that question. Major peaks have tended to arrive around 18 to 20 months after each halving. In 2017, that pattern held almost perfectly. In 2021, it was delayed slightly, but still followed the rhythm. Now, 19 months after the April 2024 halving, we find ourselves in the same window again, a period that statistically aligns with cycle tops. That timing alone has many analysts warning that we could be near the end of this run, with some projecting a gradual bear phase stretching into 2026 or even into 2027. But the data also tells a different story. Every prior cycle ended with a blow-off top, a parabolic surge driven by euphoria, retail FOMO, and record search volumes. None of that has appeared this time. The current environment feels nothing like past peaks. Instead of greed and speculation, we're seeing hesitation and fatigue. That emotional backdrop looks more like mid-cycle consolidation than a terminal top. Another key distinction is market structure. In 2021, Bitcoin's market cap was dominated by retail flows and leverage. In 2025, the composition is far more institutional. ETFs now hold more than $70 billion in Bitcoin, creating a foundation of long-term ownership that dampens volatility. Bitcoin dominance sits near 56%, indicating that capital is retreating to quality rather than exiting the ecosystem entirely, a classic sign of risk aversion, not collapse. So while historical timing suggests caution, the absence of euphoria and the strength of institutional demand suggests that what we're seeing could just as easily be a cyclical reset, a cooling phase before the next leg up. The truth is that no single narrative captures the full picture. Cycles evolve, but human behavior doesn't. And in markets like this, fear often does more to build the next rally than optimism ever could. If this really is the beginning of a bear market, we should see confirmation across several key indicators, not just one or two. The goal isn't to predict a top in advance, but to recognize when enough evidence aligns to confirm that momentum has shifted. Historically, when 4 or more of these metrics trigger at the same time, the probability of a full bear market rises sharply. So pay attention. The first one is on-chain valuation. Metrics like MVRV Z-score and the Puell multiple both tend to overheat near major peaks. When the MVRV climbs above 7 or 8, or Puell exceeds 4, it signals that long-term holders are deep in profit and are beginning to distribute. Right now, those both remain well below the thresholds. The second is technical structure. A death cross, that's when the 50-day moving average falls below the 200-day, has preceded every prolonged downtrend since 2014. Now, combined with a bearish LMACD crossover, it suggests that momentum has turned, and at the moment, neither condition has appeared on the weekly chart. The third is sentiment. When fear and greed index pushes above 80 and retail FOMO floods search trends, that's usually when the market is most fragile. In contrast, today's readings between 23 and 42 still indicate fear, not euphoria. Derivatives also tell the story. Overheated funding rates and rising open interest while prices fall often mean leverage is building up for a larger unwinding. Funding rates are currently neutral to slightly negative, a sign that speculation has cooled. Finally, watch capital flows. ETF net outflows greater than $500 million per week or rising stablecoin dominance both point to investors exiting risk assets. For now, ETF flows remain balanced and stablecoin ratios are steady. When these signals cluster, overheated valuations, bearish technicals, excessive leverage, and outflows, they've marked every major top from 2017 to 2021. And at the moment, none of those conditions are fully present. Now, that doesn't rule out volatility, but it does mean that by historical standards, the data does not yet confirm a completed bull cycle. The evidence still points to cooling, not collapse. Now, to argue that the top isn't in yet, we can look at the same framework from the other direction. Just as clusters of bearish indicators confirm a peak, clusters of bullish or neutral signals suggest continuation. And right now, more evidence leans toward that second scenario. Across more than 30 on-chain and technical indicators tracked by analysts, fewer than 20% are flashing peak cycle warnings. During true market tops, nearly all of them light up at once. That gap alone points to unfinished momentum. And price structure supports the same view. Bitcoin is still holding within the 38.2% Fibonacci retracement zone between $80,000 and $90,000, a historically strong support region during mid-cycle corrections. The 52-week weighted moving average, another long-term trend gauge, also remains intact. Until those levels break decisively, the broader uptrend remains structurally sound. Liquidity is another crucial factor. Expanding money supply, rising M2 levels, and growing stablecoin capitalization, currently approaching $200 billion, it signals that risk capital is still present. That liquidity is what fuels the next phase once sentiment shifts. Institutional inflows also remain steady. Bitcoin ETFs have recorded more than $1 billion in net inflows over the last few weeks, and on-chain data shows long-term holders adding rather than distributing. Those behaviors don't typically occur during true cycle peaks. Even sentiment is supportive. The fear and greed index sitting between 20 and 50 reflects moderation, cautious optimism, not mania. Combine that with bullish divergences on the RSI and the MACD, and it suggests the market is resetting, not reversing. Finally, Bitcoin dominance continues to hover between 55 and 60%, a range that usually reflects capital consolidation during transitions, not flight from the ecosystem. In 2023, a similar setup preceded the eventual rally to $100,000. In short, the ingredients for a final top aren't there yet. The data looks more like a market catching its breath, one where patience may prove more valuable than prediction. All of these indicators help outline probabilities, but sometimes it's not the data alone that defines a market's direction. It's the shock events that force those probabilities to play out in real time. Every cycle has one, a moment when leverage, sentiment, and macro pressure collide. In 2022, it was the UST collapse, and that unraveled an entire ecosystem. In 2025, it was the October 10 liquidation event, a sudden stress test that revealed just how far the market has come since then. The October 10, 2025 liquidation event and the 2022 UST Anchor Protocol collapse looked similar on the surface, fast, violent, and confidence shaking, but they were fundamentally different in cause, contagion, and aftermath. Start with cause. October 10 was a macro-driven leverage unwind. A tariff shock hit risk assets, perps were crowded, funding flipped, and forced selling cascaded across venues. There was no protocol failure. In 2022, the failure was self-inflicted. An algorithmic stablecoin depegged, Anchor's incentives unraveled, and the collateral feedback loop took Terra down from within. And contagion tells the second story. In 2022, UST's collapse transmitted through lenders, funds, and exchanges. 3AC, Celsius, and eventually FTX, creating a credit crisis that extended well beyond price volatility. In 2025, the spillover was limited. Exchanges processed record liquidations, some front-end struggled, and a few venues compensated users for slippage, but there were no systemic insolvencies or lasting market structure breaks. Recovery is the third difference. Post-UST, crypto entered a prolonged deleveraging with persistent outflows and regulatory overhang. In October 10, the market stabilized near key supports. ETFs resumed net inflows, and on-chain data showed long-term holders absorbing supply. Price action behaved like a severe reset rather than the start of a credit-driven winter. The lessons are straightforward. Leverage is still the accelerant, but source matters. Environmental shocks without balance sheet holes tend to heal. Internal design failures create lasting impairment. Market maturity also matters. With ETFs, deeper liquidity, and better risk rails, 2025 absorbed stress faster and contained it better. Practically, treat macro-triggered flushes as tests of structure. Watch for funding normalization, functioning collateral markets, healthy basis, and the absence of credit fractures. If those hold, as they did after October 10, the base case is reset, not regime change. When markets reach this kind of crossroad, the smartest move isn't prediction, it's preparation. Investors who navigate uncertainty best aren't the ones who call the top or the bottom. They're the ones who use data to manage risk with discipline and who don't forget to take profits on the way up. The simplest way to do that is to build a checklist of confirmation signals. Use on-chain tools like Glassnode, CoinGlass, or CryptoQuant to track the same indicators we've discussed. If you start to see 4 or more bearish metrics align, overheated valuations, outflows, leverage rising, or technical breakdowns, it's time to turn defensive. Now that doesn't mean panic selling, it means scaling out slowly if you haven't done so already, tightening stops, or holding a larger stablecoin buffer. On the other hand, if price continues to hold major supports, ETF inflows remain positive, liquidity expands, and sentiment stays fearful, the odds still favor continuation. In those environments, scaling back in cautiously makes sense. Macro still matters, so keep an eye on global liquidity, rate cuts, balance sheet expansions, or major fiscal programs. They can all reignite momentum. Likewise, watch the dollar index, the DXY, and bond yields. Strength in either typically pressures crypto. Weakness tends to free up risk capital. Now, this isn't about certainty, it's about stacking probabilities, aligning signals, and staying adaptable, because no single model captures the full picture, but together they can help you position rationally, not emotionally, in a market where fear and opportunity often look identical in real time. If you want to keep building that understanding with real data and clear strategies, visit learningcrypto.com. It's where education replaces guesswork and preparation replaces prediction. See you in the next one. Have a good day.